Yep. Let's see, got it. Hope everybody can hear me, see my screen. We good. I'm Micheal Suttlar, founder at Black's Academy. One of my favorite students, probably best student, Kim, is riding with you guys over at with Jordan's crew over at Martin Investment Group. And I'm really excited that I got the opportunity because I've never thought of a group that would be like this. I mean, I feel the vibes. Jordan, your shit's popping, bro, like for real. So just a little bit about me to kind of give you like, why would I, be giving out information real short on a really long story. I've been a trader since 2005. So I've been in this game for a long time. I transitioned from retail to institutional in 2010. But before then, my real motivation was honestly to buy my wife a Tiffany diamond ring. So I started, believe it or not, started Forex back in the day when Forex was leveraged. And that's foreign exchange. Hopefully y'all have heard of that. That's not the scam version. Like I actually am licensed to trade Forex futures and some other derivatives. I'll get into it a little bit. But I started out really with a fascination for the markets that I knew nothing about. My background is actually engineering. I quit my engineering job in 2015, but before then, I started about 2 years in. I was a radar millimeter wave satellite type guy, developing stuff that goes boom and across the world, for the military. So taking that kind of outside approach is what I learned from, I guess, engineering. I started applying to the markets. And from that, I had some success, but like everybody else, is like I wasn't really getting anything. The one thing I learned how to do was trade the non-farm payrolls, the labor report, the first Friday of every month, and I would lever in and kind of get myself maybe a 50-50 bet. And I started with basically $250, and by the end of the year, I ended up with about 28,000. But it was not like from here to here. I'd broken my account. I'd got margin called at least 3 times. Had drawdowns 80-90%, which is a waste of time. This is all my beginning stuff. Once I kind of got my feet under me and figured out, you can get lucky, I really started looking for systems that made sense because, again, I'm an electrical engineer. I worked on how to build, how to integrate things. So my whole path from 2005, really for the next 3 years, was to find some way to integrate what I knew, what I was working on with my master's program, electro-optics and things of that nature. What I found was there was a mathematical basis to it all. It's not like the math that you think is, we could get into it, but it's called geometric Brownian motion, but that's not really accessible unless you're a quant. And at the time I was not a quant. I do some quantitative things in the market. We have written some algorithms, but that's not how I get down on a daily basis for myself or for my clients. For the most part, what I'm going to show you today, Elliott wave, I'm sure a lot of people have heard of it. My bet is if you're anything like I was way back when me and Moses and Jesus were trading, none of y'all really, knew what it was. So it's like one of those things, seems interesting. You look at it and you're like, nah, this is not for me. I'm gonna go with something that's more accessible. Well, I'm going to try to show you first why the waves work, why it's actually more accessible than you even imagine. It's how the market actually works. You don't have to believe it for something to happen. It's kind of like gravity. Gravity happens no matter what you think about it, even the flat earthers out there. But the last part is to also show you kind of how it works, and it's for any market. I was talking to Jordan earlier about what a trade, and I've said I started out in Forex, but I kind of went backwards. I went from Forex to futures to options, and then I tried a little margin trading stock, and I realized I love derivatives. So I got my first license as a commodity trading advisor to run a hedge fund, my own hedge fund. I built out of my own money. I skipped a part here because in 2008, when the market crashed, I ended up turning about, net position was about 20 something thousand, not a lot of money, into almost $300,000 in about 4 months. And that was mostly through longing the dollar against some of the currencies, playing long puts against the market. I can remember distinctly going to get my iPhone 2 at the same time I was shorting Apple via put options in the market. And a $500 put ended up being $16,000 Then they end up short and getting burned on Bear Stearns, making a lot of money on Lehman Brothers. And in this doing, I thought, by the end of the year, I'd made more than twice my salary as a young engineer. And I was thinking, the hell with that. So, and having learned about what hedge funds were, what proprietary trading was, it had really blown my mind. I'm really, even further back, I didn't mention this, I'm a kid from Mississippi, a little town called Yazoo City. Nobody knew about trading. Nobody knows anything about that stuff, but I went to the military academy, Air Force Academy for school, learned about engineering, all that kind of stuff. But one of my best friends is the one that put me on. And so in that spirit of good friends, I try to pass this along to everybody that I learned. So it's been an iterative process. I've talked enough. I will get more into the fact that after the great financial recession, making a lot of money, I got burned in 2009, started, like I say, the hedge fund in 2010, mostly friends and family money. A few people that I really didn't know, we raised about $200,000, got started, got my butt kicked for a good 2 years, but didn't blow up. Really found my footing around 2013, 2014, really killed it. And I left my job in 2015, if that gives you any indication of how well it was going. And it should. I had a really good year. 2016, 2017 sucked, 2018 sucked. We're in a renaissance period now. 2019, 2021 was even better for me. And this year is probably going to shape up to be even better because we've grown from that 200,000. We went down a bit to about 2.5 million, hung there for a while in assets, total assets under management, my money plus client money. But now we just crossed 10 million in assets under management a couple of months ago, and we're probably going to double that. So I say all that not to cap off or be like, oh, I'm blah, blah, blah. But I'm telling you, I started with 250 and didn't know what I was doing, scared out of my mind, but excited. Now I'm less scared about the entire process. I'm still a little bit, when I put trades out like now, any given day I can lose anywhere from $40,000 to $80,000 in the market. But I don't really think of them in that terms. That's like, that's a 0.5%, 1/4%, somewhere along that of the portfolio. So the other thing about Elliott that I have to say, yes, it can seem complicated for a lot of y'all that have, I'm sure I'm looking at, 60 some people on the chat. Actually, more than that now. All the people in the chat, I'm sure some of y'all have things that work. The reason why I stuck with Elliott, and I've kind of made my own amalgam of Elliott, is simple. If you scale up in size, some of y'all, your traders, maybe we do have some 6-figure traders out there. Congrats to you. I will tell you, to go from 3 to 4 to 5 to 6, up here has to change. Your mindset has to change, but your tools also have to change. And for me, using Elliott with everything that I've used moving averages, and you name it, I've probably tried it. Algorithms, bots, we even do some AI and machine learning types things. But the core basis is based on the fact that Elliott says that the market moves in a certain pattern. And one of my favorite proprietary traders on Twitter just said the other day that the market, if you're trading in the market, your job as a trader is to find patterns. That's rule number one. So if the market moves in patterns, I want to know what those patterns are. That's how I got started. So I'm going to take you to the basic premise assuming that everybody's not heard this before. Elliott wave theory is a principle that says that the market, like I said, moves in an ordered fashion. And this really doesn't come from exogenous data like earnings reports or CPI, but it's really the development of how human behavior in the confined space of actually trading. And when I say confined space, as a trader, if you're into market theory, if you're into auction theory, heard of anything like these natures, what you know is there is only certain ways that you can actually move the price. The price can only be moved by, again, somebody either upticking or there's no buyers, no sellers, that sort of thing. If there is no buyers and there's no sellers, a public market does not function. Elliott's principle says that if a market is liquid, this is what you have to have. If it has a diverse set of players, which again, you have some retail, you have some speculators, you have some prop traders, you have some agency traders, you have some banks, just like we do now, the better it works, the more people you have. Because what you can do in the market is really simple. You're either going to buy You're going to either sell or you're going to do nothing. The entirety of your complex brain is characterized in those three behaviors. All the market history, if you look at the price history for any market, according to Elliott wave theory, Dow theory kind of goes along the same way. All the market is contained within this. Now, if you get into really academic stuff, you get into like random walk, Burton Malkiel, 1932, came up with this thing, the random walk down Wall Street. If you haven't read the book, you can read it. They assume that the market is completely random. Elliott wave is the opposite of this. It says that the market has order. What I find in actual practice is that it's a bit of both, but Elliott's theory having the logical steps is, to me, better than just saying, oh, it's random and you're just going to take some odds and shots. We know that luck is a part of trading, or at least if hopefully you've traded long enough to figure that out. But the skill part for me is learning about the wave theory. And as I said before, I'm going to kind of roll through this part because I've been blah, 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 blah about most of the history stuff. I like to take the history because I am a market historian. I probably read like 250 books on markets since 2005. But the thing I like about Elliott wave theory, when you use it correctly, all the other stuff you use, your candlesticks, Fibonacci, support and resistance, I didn't even put on here price action. One of my traders on my team has shown me how to integrate price action into what I check off on my Elliott, and it has taken me to another level. If you're a price action person, you can probably do the reverse, and it does the same way because he was like that. He was price action. Elliott wave helps him refine what he's looking for. But even simple stuff, trend lines, technical indicators. I love candlestick patterns as a confirming indicator for what my Elliott wave stuff says. It all comes together. Now, almost, and you can see why the engineering STEM part comes into one of the basic premises of Elliott is every action is followed by a reaction. It doesn't say it has to be equal and opposite like in thermodynamics, but it has to have an opposite. So if something happens in the market, something else is going to happen that is opposite to it, some type of reaction. And you can see this when you have earnings reports. You're going to see that when the earnings reports is released, the market makes a jump, even if it's not correlated with what the data says actually in the earnings report. Why? Because like Elliott says, most market action is the result of our expectation of what's going to happen, not actually what happens. But the cool thing about Elliott is that it takes this high philosophical, our human behavior, blah, 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 into a codified, what you see here on screen, one cycle going higher, or it could be going lower, and then another cycle. One action of 5 waves, 1, 2, 3, 4, 5, counted in numbers. We call those an impulse. And typically when anybody knows anything about Elliott wave, they get stuck on the impulse. Don't do that. The other part is the correction. Now, this is not the same as when you're in economics and you say a correction is a move against the trend of the market by 20%. This is not the same. An Elliott wave correction is simply a move made of 3 waves that goes against the main trend. Now, the really interesting thing here is, and this is, we'll get a little bit into this when we talk about Fibonacci. Elliott is implicitly linked and explicitly linked with Fibonacci. Now, I know a lot of people, I see Fibonacci online. I don't see it used right a lot. Part of the reason why I'm looking to teach this stuff is because I want to teach it in a manner, not that just upholds the theory, because I don't know these dead cats. I mean, that's not really my thing, but it's really to say, hey, we got cats out here, we got black cats out here really trading, really grinding, want to expand. Trading has, changed my life drastically, monetarily, spiritually, mentally, all the illies, all of them. But if you're going to learn this, you have to learn it correctly, and then you put your own spin on it, which is what I've done, and I'm looking to do that. But we have to start with the basics. But again, this basic sequence of 5 and 3 waves to go in the opposite direction, if you count them, is 8. Well, this is based off of the Fibonacci sequence, which is basically any sequence of numbers. When you add the first number to the second number and put them together, you get the third number. So the Fibonacci sequence starts with 0, then you add the next iteration, which is 1, then you get the first number in the sequence. 1, 2, 3, 5, 8, 13, 21, 34, it goes on and on. This system is ingrained, and Elliott didn't know this. Ralph Nelson Elliott, the guy that made this up in the 20s, He didn't know this. It's just something that happened naturally. One of the more fascinating things that I found, again, being an engineer, is that when I looked at Elliott wave and I looked at Fibonacci, I found these same patterns of growth and expansion in nature. If you look, and somebody can go try this, if you look at your actual hand, if you look at any body part and start measuring it, if you measure the lengths of the digits, no matter how tall or how short you are, no matter what your dimensions are, if you start dividing the digits by the whole, you'll start seeing Fibonacci numbers. You'll start seeing 0.6.8, 0.382. Don't count half as a Fibonacci number. It's not a true Fibonacci number, but you'll start seeing these same things. This is the basic background of how we connect this all. Again, I've worked in satellites and stuff like that. The synodic periods, which are the distances planets are from the sun, has this same repeating thing. I'm not trying to get too far out, but it shows you that there's a practical basis to this all that actually supersedes just stuff in the market. It actually is a very natural cycle. Now, taking that same look, we're just, and I appreciate Kim, who again, shout out to Kim for putting me on to you guys and you guys listening. This is one of her charts. And I love it because Kim, again, is one of my favorite students. After this, she's probably going to, low-key, she's going to be my favorite student, just don't tell her. But this is one of her charts of Vinco Ventures. And you can see in the white space, I took that same superimposed position of the basic wave structure, the 1, 2, 3, 4, 5, ABC. I'm going to give y'all a second with this chart. I'm hoping that out of the about 100 people that are on here, probably a few of y'all, maybe 10, probably automatically see this. They probably automatically can make this out. For the rest, there it is. If you take your time, what's in the white screen in the straight drawn lines can be drawn out. And it just depends. It depends on how much, how well you are at pattern recognition of this type. Some of us are better at it naturally than others. I will tell you, when I first learned about Elliott wave, I didn't see it at all. Like I read and I read and I tried and I tried. I didn't see anything. So if you don't see anything, if it just looks like me having a paint session, it'll come to you. You just got to stick with it. But this motive move of a little move up, this retracement, this move against the grain, and then a big, big move. And this big, big move probably had earnings in here with this gap. Move up to another high, this pullback, and then you go to a peak, and then you change directions. That is a logical sequence that is core to Elliott wave, because I'm showing it to you in a complete sense in the past. As an Elliott wave trader, what you're trying to do is find this pattern in the future, because if you land at any one of these spots and they're there, you know what's going to happen next, which is one of the things I don't like to say predict. I don't forecast. I'm not that guy. But my premise with Elliott, my premise with trading at all at a high level, again, at a 8-figure level now, is preparation is better than prediction. I use Elliott waves logic to prepare me for what might happen next, because I don't know the future. I also use Elliott waves logic to help me out with risk management, because if I know how this looks and where these levels are going to stop, and you're like, how do you know where the market is going to stop? Well, there are rules to the game. There's rules to Elliott wave, which turns just about everybody off. But for those that you can endure, and mind you, this is for people, like I said, if you have a system that you're happy with, this is a lot of effort for nothing. If you want to improve, you're not trading like you want to, this is for you. Or if you're like me, you've already made it to a certain level and you want to go higher, this is for you. So it behooves you to take close attention to how this moves. It looks exactly the same way, and I'll show you a lot of other examples. We even do some live examples. It looks the same way. And once you figure out these patterns, and they have certain variations to them, you get used to that. You learn what to expect. You learn where to go long. You learn where to get out for profit, where to scale into a trade. Like a lot of people, one of my best things I like to do, I used to try to get in and try to beat it to wave one, the beginning of wave one down here. But instead, my best trade is when wave two drops in here. You can see this 0.5. This is just 50% of the move from this low point up to this one. In Elliott wave, we put the labels at the end of the waves or the end of the move. Once it pulls down here to 50%, and 50% is a number that happens a lot. So it's 38.2, 61.8. You try to enter the market here. And one of the things that I'm kind of jumping ahead a little bit, in risk management, you say, well, what if it doesn't work out like that? I'm putting my stop loss or I'm exiting a trade if for whatever reason it goes down below the beginning of here, because that's not what's supposed to happen. That's not what this nice little Elliott wave structure here looks like. So I'm capturing all of this. I might not take all of my trade here, but I might shave off half of it, pocket 60, so anywhere from half to 80% of a pocket there. I may scale back in over here at wave 4. And then again, up here at the top, wave 5 is where you want to get out for exit. Now on the other side, as it comes back, recedes, wave B, this is where I want to go short. I've already seen the top. Some people may recognize this as a head and shoulders. It is, but people interpret head and shoulders way differently. The thing that's with Elliott wave is that you combine Elliott wave with Fibonacci. You can't have one without the other. You can trade Fibonacci without Elliott wave, but you can't trade Elliott wave without Fibonacci. But if you're trading the Elliott wave sequence, this B wave only comes up a certain percentage relative to A. This is how you set your guidelines of where the market goes. If it goes outside of that, you're wrong. It's not the right spot. So as you learn to trade swings. And one thing I have not mentioned yet is the fact that these waves happen at any time frame. You can trade it monthly, you can trade it yearly, daily, or you can trade down in the ticks. So if you're a day trader, you swing, a scout, you can use some of these techniques because the logic happens at all levels. Now, if you're on the lower end of the time frame, you're a tick 1 minute, 2 minutes, sometimes like I am in futures, you have to learn how to use the rules quickly. One of the things that you can see, and I show just sort of a generic chart here. I show another chart. This is in my home territory in Forex. This is where I cut my teeth. Again, it's the same premise. You're going to see the same types of moves all the time. And that's really reassuring because, and the reason why I'm highlighting this green area on this chart, even if you miss the first entry here too, you see the big part here. Some people may say, well, the best part of the market is happening, or I'm just going to buy the dip. They might try to buy through this area, or they might buy through here, and then they finally get here. One of the things we learn to do when you're learning Elliott is to be precise. Well, you say, well, market's kind of messy place. You don't have to be all that precise. Well, if you're more precise, think about it like this. As a trader, we said rule number 1 is to see patterns. Rule number 2 is to have the right timing. And I guess you say rule number 0 is to protect yourself at all times, but that's kind of like a neither here nor there. But if you have the right timing, you know when the market's going to turn, and you can figure out where it's going to turn. If you position yourself correctly and set your stop losses along these lines, you can make much more on each trade. Like you might have a trade that you normally would make 3% on it. Using Elliott wave, you can optimize that trade can be 10%. You may have a trade that you make 10% on, you can make 30 or 40%, 100%. Most of the trades that we look at are, I'm not interested in if I don't make 300% on a trade. And that's 300% relative to how much 1% I'm risking. So if I'm not making 300%, I'll say that again, I'm not really interested in the trade. And the reason why is I spend a lot of time trying to figure out where to get in and also where to get out. And we'll talk more about these lines, why these lines intersect in a bit. One of the things I've shown you is that the waves are going up. That's a common thing whenever you're seeing Elliott wave. But the thing about Elliott wave is that the waves move down as well. They move down, they move up. So you can have that nice motive move down when the trend changes. You just change with the trend. One of the weirdest things I saw in 2020, 2021 with all the new traders coming in, all people knew how to do was buy the dip. And I'm like, excuse me, I mean, I don't want to offend anybody, but if you can't short, you're not a trader to me, because your job, again, is pattern recognition and timing. If the market is changing course, you need to be able to change with it. Elliott wave helps you do that too. This is Coinbase. Again, in terms of stock, I thought it was trash. I love trashing Coinbase because it was masquerading as something that it wasn't. In this, what you see here, I'm showing you the same Elliott wave pattern that we did here, but in reverse. This is the ABC part coming down. Here's another ABC part coming up. And then you get the 1, 2, 3, 4. And notice this, pay attention here. This isn't finished, but based on how it looks, my expectation was that it was going to come down, not go up. This is how Elliott helps you knowing the sequence. If you know, just like you know how to count 1, 2, 3, 4, 5, if you have the right shape, if you have the right look to the market, you know with a great sense of certainty, not 100%, I have to say that, but you know what's going to happen next. And in knowing what's going to happen next, you take half the game out. Half the game is a guessing game. If somebody tells you they're not guessing, they're not really trading, or they're just having a good time losing their money or somebody else's money. It's a probability game, no matter if you're using Elliott, no matter you're using Bollinger Bands, no matter you're using candlesticks. I don't care your system. This is all probability. Elliott, to me, helps because what you do is you train your eyes to look for this sequence or this ABC sequence. Once you start learning them, once you demo them, you trade them, you measure them, you know what's going to happen here. And again, with Coinbase, one of the things I like to do is use my Elliott wave tools to get ahead of an earnings report, because I like to trade options, just basic longs and puts and calls, long puts and calls, nothing fancy, no iron condors, no spreads, no verticals. Don't need that. I need that pop, and I need direction. Elliott can tell me direction. And like I told you before, it can tell me timing. If I can gather all of what I think is going to happen, I can measure out the risk and figure out what's happening. Here is the same thing. The waves here give you the sequence. I just went backwards from what I showed you, but it's still the connecting ABC to 1, 2, 3, 4, 5, or 1, 2, 3, 4, 5 to ABC. You just have to know the rules. Now watch. And granted, this is kind of a loaded thing, but this is a chart I did, again, back in February, ahead of the earnings that it had in March, right? So this was my forecast. It wasn't really a forecast. I'm not trusting anything. I didn't know anything about the earnings. I didn't care. What I cared about was my wave count correct? Were my Fibonacci levels correct? And if you see these lines here, these horizontal lines along the bottom are nothing but Fibonacci levels that are taken off the lengths of this wave to this wave. What I'm doing is I'm literally measuring the lengths of the market moves. And like Elliott says, all market moves at a certain degree are connected. If they're connected, they're like kinfolk. And if they're like kinfolk, they're going to look alike. And so if that's the case, you can use the math part to link up and show you where the market's going to go next. And here it was. Now you move forward to April 28th. Now, granted, we were here at this 4. We moved down into earnings just like I thought. Moved up a little bit, then moved back down again. Now, I thought Coinbase was going to hit this level, this 100% level, because that means if I take the length of move from here, from its IPO down to its lowest point from the IPO, back up to the next highest high, and project that same length, 100% of that length, from this point, I get this one. I already had it on the prior chart. It was already here. I'm already calculating. This gives me some advanced idea. Does it work all the time? No. Does it work better than half the time? Hell yeah. It works as good as you are with it. So in knowing this, I knew what direction we were going. That's half the battle. The next thing is just figuring out what levels. Oh, wait, I know what level, right? I calculated these ahead of time. You can calculate them as soon as this hits and this hits. That's November of 2021. We're talking about stuff that happened in March and April of 2022. That's ahead. But again, don't get it confused with forecasting. All we're doing is following a logical sequence of events. Now, again, is it perfect? No. It's only as good as you are with it. Well, it could be a little bit better. But the best part about this, and this is for people, depends on how you think. as a trader, one of my adages is you have to be flexible with your mindset. You have to be able to change your mind. Cool thing about Elliott, I got all these 1, 2, 3, 4s, 5s, and letters and parentheses on here. Guess what? The theory stays the same, but as I'm presented with new data, like say if I thought that the market was going to go up and make another 1, 2, 3, 4, 5 or ABC here, and it doesn't, it starts to crack down. All I have to do is adjust. Instead of my 4 being over here, I change my 4 to being here. Now you say, well, how can you do that? You have to know a little bit more about the Elliott wave rules. I'll include some. There are a lot of rules. It's one of the drawbacks why people ignore it. But if you know the rules, you know which ones to use and you get faster at it. So again, I'll go back. This is what I thought. This is what happened. And now I just make downward adjustments. I'm still directionally right. I haven't gotten turned around in the market. So in my mind, all I'm thinking about is what strategies do I need to go and what price do I need to go to? Just like I had this 88.6 and this 100, I've got another mysterious number down here. Hint, it's a Fibonacci number at 127.2. There's some numbers below that, 138, 161.8, they keep going. All of these things work in tandem to give you direction, which if you're a beginning trader, you're midway in your career, you're looking to have a breakout like I'm talking about, where you can scale up in an account size, add some zeros, direction is it. Timing is the next part. Now, one of the things I talked about earlier, and I'm going to just go backwards here, kind of bring this down a little bit. There are two types, general types of Elliott waves. There's an impulse wave, that's that 1, 2, 3, 4, 5. And then everything else is considered to be a correction, ABC. Now, when you get into ABCs, and the Elliott has a lot of these quote unquote gotchas, but they're not really gotchas, it's just more detail. When you get into the corrective waves, there's a lot of different types of corrective waves. Now, the corrective waves are the ones that, believe it or not, are in the market more than the impulse wave. It's just that the impulse is really easy to see, has kind of these nice, neat rules, and it doesn't change much. But the corrections, they have different styles, different variations. The one that I say, if you're interested in learning anything about Elliott wave, the zigzag is 3 waves. All corrections are 3 waves. No more, no less, with one exception. The zigzag here is the basic, super bare bones basic, like pattern. To me, it does this thing. And again, you can flip this upside down. Just hopefully mentally you can make that translation. If not, we'll do some on the charts. But it starts from a market could be either going down in this situation or it could be a market going up. But there is an inflection point. There's a change in direction. From that change in direction, you get a move that goes up. It extends itself from that change in direction. Then it kind of goes sideways. This is our retracement where it goes against this original grain. And B is always that guy. B is always, it's not a directional move. B always goes sideways or a little bit down or against a trend. And then the move here, C, is going to be related to A and B mathematically and also in time. But as you can see, A and C look about the same length. Sometimes C is a little bit longer, sometimes C is a little bit shorter, but you can measure it based off of what B looks like and what A looks like. It doesn't get much better than this because what you want to do, you observe the market going up in A, you observe B, and B's typically going to look like this. You see this sideways action where it looks sort of like a W. That's key to how it looks. That W is going to come down to a certain spot, a certain retracement based on how long A is, based on the Fibonacci numbers. You want to enter the market here. You want to use another Fibonacci number lower than this to place your stop loss, and you want to profit at the end of where you think C is. And there are a couple different levels, and you can take it kind of in pieces based on what you see. You don't have to say, oh, a set in stone is always going to be one level. You can take it in multiple levels, and this lets you, again, scale out of a trade. You can say, oh, well, I'm going to take some of the trade off the table. If you're trading, 100 contracts or so, and you want to take 50 of them off the table, so be it. You still got to have the trade to let your profits run. Because one of the things about being wrong with Elliott, if you got the direction right, is it's good to be wrong when you say, oh, well, I only thought that C was going to be here, but it extends. That's something that can happen. You want to take advantage of. What you want to do is eliminate getting messed up in direction when the market starts changing and you don't recognize it. Oh, well, that's a B wave or that's a period of consolidation, whatever you want to call it. But again, this is the basic pattern. Don't worry with the impulse yet, because to be honest, if you can figure this out, you can figure out the impulse next if you want to. Here it is in Roku. Again, this is one of our, I think one of our students did this chart, but you can see we start down here at a low, and typically in the up markets, you're looking for some change in direction, and you don't have to worry about trying to nail this bottom. That's kind of, it's weird behavior. I mean, granted, I used to do that all the time when I was a young trader, try to nail the bottom. Just it was more like a ego thing. But what you do is you wait for the move to happen. Once this move happens and the market starts to make red candles in the opposite direction, you're retracing. You can take the length of this A wave and start measuring out as soon as it starts turning. You know it's there. Take the measurements. You know that 38.2% is here. 1/2 is here, 61.8. I will show you a ton of other Fibonacci levels, 78.6, 88.6. There's lots of permutations. Again, I'm a math guy. I got them all. I got all the math you need. Just follow along. Some of you may know candlestick patterns, know that this, this candle called a lot of things, but in basic terms, you would consider this to be a bullish engulfing 2-bar candle where you got a red one here, big engulfing here. I don't know if you guys use like strat. I mean, there's lots of other things. I mean, this candle here sitting on this Fibonacci level shows you support. If you're a price action person, you probably already see it too. If you look at the lows here and look backwards, it's tagging all this area right through here. So it's like an order block right through here. Elliott works with these systems. You can integrate it in. You enter here, you can put your stop loss below here or below here, depending on how much you want to concentrate the trade. And you automatically, before this even happens, you're targeting up here. And if you don't want to get out, what you can do is set an alert and then make the decision after the market has made its move. Again, it still keeps you in the situation of control, but you're not necessarily compelled to make an action. That's the best thing about this type of trading. I use this type of trading to exit my job because I didn't have time to sit in front of the screens. I literally would place limit orders with stop losses at prescribed spots in the market, believe it or not. And it was either going to hit my stop loss or hit my target. And I'd check it at lunch or whenever I had a break. But I had no control during the day, but I made enough money to exit, again, a 6-figure job comfortably with enough money to hold me over for 5 years. Some of that was investing money, but most of that was trading money. And my trading style has since then centered on Elliott wave and this logical discourse of not predicting, but preparing for what should happen in a logical sequence. We'll go over this a little, but I want to take a few charts right now. Jordan, if you want, we can actually start asking some questions, answer some questions that people have, but I want to take it to the charts now so I can show people that this isn't just static charts. We can do it just about anywhere. Because I feel like I've been doing a lot of talking. Anybody, we good? We want to take some questions at this point? Y'all got any?
Yeah, I think Jordan stepped out. So
okay.
If anyone had questions, or you can go straight to the charts.
All right. I mean, hey, it's whatever. I'll go to charts. Unless we got some compelling. I hadn't looked at the chat yet. Oh, there's a raised hand. What are we supposed to do with this? Let's see, tap him in. Somebody tap him in.
Mike, do you want them to be able to unmute while you're teaching?
I'm good, man, as long as it's not like, everybody all the time. But yeah usually I get a few questions. I'm good.
I'm gonna allow individuals to do it one by one.
See Darius in this joint.
Okay, yeah. I had a question.
Sure.
When you chart when you charting, do you always start at the IPO and then
Nah,
move to your right side? Or
absolutely not. No, 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 no. I'm glad. That's a great question. Let's get to it. So the only reason why I started at the IPO for Coinbase was because it was the beginning of the chart. I typically
Okay.
don't like IPOs in general, but I mean, that's all the data I have. And a lot of other systems, you can't work it out. But what I saw from this IPO, like let me show you. If I had just this, guess what I can't do? I can't do Elliott wave really well with that. I don't have enough data. So I just watched that one play out. I let it play out to a certain level until I start to see something. And I'll show you in general. I was going to do the charts because I like to draw anyway. I'm looking for something to do something like this, or I'm looking for something to do something like this, or I'm looking for something to do this, or this. Now, granted, the looks are just part of it. That laundry list of rules that I had up, that's the other part. But yeah, I don't really start from, just an IPO, because depending on the company, the IPO could have happened a long time ago. So I start from typically looking at very high and low points in the market. Let's see, let's pick an Apple. I probably got some stuff already on here. Yeah. I tell you what I'm gonna do. Let's take this off. Where the rest of, there we go. So in something like Apple, and I'm on 4 hour, I would definitely go up higher. And that's the thing about Elliott. You can go up as far as you want to. If I were to go, I can chart all the Elliott wave patterns in here, like through here. For example, a lot of this stuff I don't have to look at. I know that this hits around 44.7 or 50% of the move. See here, actually a little bit lower than 61.8. Yeah, 61.8. But if you're a price action person, you can kind of see this already. But I'd like to start, if you notice, and I didn't draw this well, I like to start from meaningful lows or from meaningful highs in the chart. Like you can honestly get busy with Elliott wave going what people would consider to be backwards in the market, like looking from this high, for example. Believe it or not, this higher high here has a Fibonacci relationship with this one. Watch. And I'm telling you, this is not pre-canned. This is just lots of years of practice. So what I'm going to be measuring is, and Darius, I hope that answered your question, man. You're probably like, man, why you just rambling on? But
no, you do it. Yeah, I appreciate it, man.
But I'm going to show y'all how Fibonacci should be used. I see all these negative fibs and weird stuff. Fibonacci doesn't work. It's really easy. You go from one spot, that's a high, and you can see it. You observe it in the screen. If I look to the left, there is nothing higher than this point, at least in the immediate position. At this low point, I have to go back beyond this high point to find a lower spot. That's where you want to go. You want to measure from here to here. And my goal, I'm going to show you that there's actually a level here. So if I put my Fibonacci tool and trading view on, stretch it down to here, you'll start seeing some numbers come up. I'm just going to start doing some quote unquote guesswork. I just put the very first one on there, 61.8, and I'm going to extend it, and I'm going to take the rest of these off. That's my very first guess. Whoops, looks like it related. How do I know? Because 61.8, 161.8 are the basis of Fibonacci. These numbers are used a lot in Elliott wave. For example, if I take you back just to these zigzag rules that you can't know and can't ignore, you don't have to read all these, but look at the numbers. Whoops, got ahead of myself. 61.8, 161.8, 38.2, here's a range, but you can kind of see the same numbers are repeating. That's part of the design. The numbers give you the constraint. Drawing on the chart gives you the look. But just like here, I can go back to this point and measure from here to here. and find another Fibonacci level that relates, because like I told you, they're all kinfolk. So if I start keeping the same high, I'm going to pick a low point down here. This is the lowest point since this high. Kind of see my trend here. Once it starts to turn, and I'm going to take this off. Let's do replay. Let's act as if this doesn't exist yet, because this is kind of what you will see. If I were to say, I'm going to take a retracement from this move, this low, drag it up to this high point. My guess is going to be about 44.7, maybe a little bit lower, 50%. You can see that the market, hopefully y'all can see that good, the market got down that low. So my first guess was close enough, but my second guess was dead on. Well, I can take it a step further. Now that I know this move and this move relate, my next move is going to be some percentage of that. And I'm just going to use some of the rules that we have for zigzag. Even though this one's already kind of on here, I know it. I'm going to say now use another tool and say, going from this low to the same high. So when I do that low to high, all I'm doing is I'm measuring the distance. I'm measuring how long that is in price. When I click here, I'm going to say, I'm going to use this to figure out how long it is from this point down here. And my next guess is going to be 78.6, 81. Take the rest of these. Well, I'll leave that one on for right now. That one might hit. And I'm going to extend the line so you can see them. And you can see it's a little messy. Let me center these up a little bit so you can kind of see. Notice I got a bunch of levels that are all clustered up here at this spot. I originally took this 161.8 off of the move from this high to this low. So that's what that level is. But like I told you, this is about relationships. The waves are related to each other. So what I have here, and I'm going to show you, this is what it looks like. I have a move that goes up, comes down 50%, roughly half, and extends out. It's going to be 161.8% of that, but it's going to be about 80, 78, 86, 81% of this move. So this one's slightly smaller than this one, but they're all related. So as long as I know this move, and you know it because it's already happened. It's already happened in the past. And once the market starts going up, I can start calculating in advance, and I'm just going to let it play out. Let's slow this down just a bit. Well, that's going to be too slow. Speed it up a little bit. Jesus, can we go a little bit more? All right, I'm going to speed up a lot. I'm a little impatient. Any faster? There we go. Long and short, you know, this is my bad rabbit out of the hat trick, but it's going to go to those spots. But I'm showing you this is how Elliott is used in advance. And this is, I haven't really looked at Apple's chart in a while. Boom. Hopefully that makes some sense. DC, you still got your hand up. So what question do you have?
So first of all, thank you. Excellent information, and absolutely. So I was looking at the line you just drew actually, and it's helping me ask the question. So what do you use for duration, or how long do you stay in a trade? Meaning, do you get in a trade and hold it for 30 minutes, an hour, 10 days? So that's part one. The second part is that line was, you mentioned the length. And so how do you then use the length to approximate speed of a price movement and or duration? Meaning we're like looking at February of 2013 on the chart now. And then the move progressed, and I guess a second wave through 2015. So
right.
How do we sort of integrate speed in duration with the length that you drew based on that high and low?
Excellent questions all around, man. Like this gets me excited. This is like I get to geek out a little bit, but to answer your question, Elliott wave and Fibonacci work in price. You've been seeing what we call the y-axis. We've been talking about this, but it also works. This is gonna blow some people's mind. And granted, again, I'm not forecasting, but it works in time as well. Let me show you something. Sound like fire wants to build. Let me tell you something, but that might be before y'all time. I'm about to get loose. So if I take this move back, yeah, let's take this off. Yes, for now, I'm just gonna reset it. Just like the moves are related in price, the timing between each one of the Elliott waves, and that's why I say it's an involved kind of complex set of rules, but each waves A, B, and C relate to each other in distinct times. Like this move down can only take so long compared to the move that happened before it. Let me show you. So we're going to take the date range. I'm going to start from this low down here at the bottom where we started. I'm just going to go across. So this move, and remember, again, day traders, your scalpers, it works on your level too. I'm up here in stupid land for right now. I would never trade at this, but this is 44 bars or 1,341 days. It's a long time. This length in time, if I take Fibonacci ratios of it, I can get really close to where the market turns here and right here. I'm absolutely certain of it because I've done it several thousand times, if not more. So all I have to know, and again, up at the top, it's really, really, really pretty evening star pattern. But I'm going to take now Fibonacci trend-based time. And you can see the tools in TradingView that I use. I don't use all of them. I don't need them anymore. Fib retracement, Fib extension, and Fib-based time. I'm going to use a time tool. Time is the one thing of trading that everybody in investing, and as an investor, I don't time markets, but as a trader, I absolutely time markets. How do you do it? I start from here, same place I did with the Fibonacci retracement. I go all the way to the end, and I can do this after the fact. And I'm going to put another third spot. So you can measure it from different spots, but I'm going to measure from the same spot. And I'm going to add time sequences to it. The first one I'm going to put up is 23.6 as my first guess. And it's not a guess because this is like the bare minimum. Then I'm going to put a 33 on that. I'm not going to put any more on there because that one, 23 is about going to do it. For style points, I'm going to put probably this 14 on here. Go. And we're just going to let this play out again. This gives you the expectation of how soon something should happen in the markets. Happen just beyond that 14, watch for the next one. Right there. That's it. All right, now for, again, the next trick. If you take this move, and I'm only taking, like, you can take these measurements from a lot of different places. This is where the learning kind of goes. Even the high that happened, if I was to extend, now this was going to be a little tougher trick for me if I remember. Let's see, 161.8 is probably the first good guess. Maybe 100 because we're at, let's go 100. I'll show you how to do it another way that's going to get more accurate for here, but they all relate. So what I'm bringing up here will kind of show you, let me auto into it. And what this is basically, this 1%, this one out here sitting out is saying that this length is the same length of time from here to here. Oh, didn't quite make that high, but we're not done yet. Let's keep going. I forgot to put my, it doesn't matter. I went a little too far, but that's all right. Let's put 160, let's put 61.8 on here. Actually, here. Let it keep going. Right here. 707. There we go. I know, again, these seem like they're a little bit off, but notice where this one hit. Notice it was another turn in the market. So I guess a little bit long on here because I took it from this point. But as you keep going and as the market is show itself, you'll start seeing that as it starts to hit these lines in time, the market's turning directions. That's just based off of this length here. So DC, I hope that answers your question. Or at least partially.
Question.
Sure, let's go for it, MK.
I appreciate this. Thank you so much for sharing this with everybody.
Oh, my pleasure.
Based off of the Elliott waves and we'll say the quote unquote key Fibonacci levels.
Sure.
And you have to correct me because I'm trying to remember from looking. So 38, 50, 61, I think 72.
Yeah. I'll send you guys out a list.
Okay.
There's a lot of them.
How important do those play into the Elliott waves? Because my understanding of those are kind of like your 4 key points, and then everything outside of that is we'll say extra, if you will. But when you're looking at movements, kind of what you're doing, how important are maybe those 4 levels and then everything outside of that?
So that's how most people interpret Elliott wave. I think that's wrong. And that's not saying that you're wrong necessarily, but here's the thing. You have to treat it almost like, I like sports, so it's almost like a college football or basketball playbook. You know, you're either on offense or your defense, but if you look at the actual playbook, depending on what you see in the field or what's lined up against you, you have specific levels that play exactly in that situation. Your job as a trader is to know where you are in that situation. I'll give you an example. So if you notice, again, like here, there's a lot of, you know, your 61.8s, your 161.8, that sort of thing. 38.2 is a very common level for most markets. But if I was to switch from Apple to say maybe, let's see, NASDAQ futures, for example, and I'm going to go down in time frame just to make this fun. What I'll start to see, actually, I thought of another one too. Instead of, and I'm going to go for, I'm just going to pick, I'm almost picking random spots because this is a market I trade a lot and I see a lot. Sometimes you will see 38.2, which again is common Fibonacci level. But sometimes you will see, let me see if this one will do it. It's 38.2. And I'm going to add one more in here, 141.4. This one didn't quite get either. So it actually hit 13. Let me try again. You'll find other markets, basically long and short, you'll find markets instead of doing your standard 30. I mean, they're good guesses. Don't get me wrong. They're good. It's a good standard guess to say, you know, when in doubt, use 61.8, 38.2. But when you really start to get stylized in your learning about different markets, every market has what we call an affinity. And that affinity in the market are the levels that vibrate in that market more so than others. See, I got one extra. Where's that one coming from? Got an extra level on here that I'm seeing I don't like. Oh, take this one off. And I'm going to take this one off and center. Let's go right. You can see that this level, the 44.7 level, was much more containing of the price, like in terms of absolute lows here, than it was for 38.2. Another market I'm really thinking about too, since the CPI report was good. Yep, this is going to be a good one. Take these off. This is a currency pair, but remember, this is not just limited to one market. It's any market that's liquid. So you do stocks, crypto, what have you. If I measure the retracement from here to here, here we see that 44.7 level more so than a 38.2 will get you close. But if you want to be truly accurate in a lot of different markets, you find that these markets have affinity levels that they go to that are different than what you would normally see. So 38.2 gets you there, but in certain very specific situations, you're going to use the other levels. And when you learn Elliott wave the right way, you know, based on the rule set or based on where you are, you know which play to play. And sometimes that's going to be 38.2. Sometimes it's going to be 41.4. Actually, I have another. I'm going to take you guys into my company territory. Let's see. Let's go. Important Fibonacci ratio. So this is just a little extra information. You have what we call our first tier, our most important Fibonacci relation. And we do separate them out that way, but we have levels that you've probably not heard of, like 33, 41.4, 66.7, 70.07. And then these other lesser known levels that we derived after doing some computer extensions and stuff. So there's, long and short, there's a level for every market. It just depends on how deep you want to play into it, how professional you want to be, how accurate you want to be. If you need that, or if you're struggling with accuracy, this is what you need. If, like I told you, if you want to scale up, this is what you need. If you're cool, it's a lot of work for, there's a lot of stuff to learn for a little bit of gain, you know. Any other questions? Who's interested in thinking about, or I guess learning about this a little bit more too? I'm interested in anybody. Is this piquing anybody's interest at all? Kim, you don't count. So.
Yeah, there's people in the chat responding. Yes. I want to see if you could show that some version of, well, the NASDAQ chart, but over like the past 5 or 6 days, like the chart we were looking at earlier.
Okay.
That had the complete cycle on it.
You want to see some pretty stuff?
I'm not really pretty, but the reason was because I think maybe like 10 days worth, or maybe 7 days, I'm not sure, but it was something that I had traded over. I had mapped out based on the waves, the impulse and the corrective side, and it started hitting all the levels. And it's something that, I was able to trade over like a 7-day period, knowing, that we hit certain levels and kind of watching to see where we'll go to the next level. And in between, I'm sorry.
Go ahead.
Yeah, and so in between there was I think was it the jobs report, I think was Friday.
Oh yeah, that was good one.
And then this morning was the CPI.
Yeah.
And so, a lot of people, like, you've taught me this and taught, you teach your students this, like, don't worry about what the reports say, like look at the patterns. And if you were able to map it out via Elliott wave, you would have known that on the payroll day that it was going to go down at some point, in some fashion, or that for the CPI that it was going to go up. And so I thought it would be a good example for you to show, to kind of map it out so they can see you can do one pattern over several days. You can do one pattern over, 2 hours, like
2 hours a month, yeah.
Because these impulse patterns and the corrective patterns I see often, or I see most of them often, like just day trading. I can eyeball it and I can see I'm at level 4 and I can just go in for a quick trade because it's going to shoot up to level 5 and get straight out.
Absolutely.
So just wanted to see if you could show that.
Oh yeah, so I'll give them one from this morning. Let's see, which way do I want to start from this? So for the most part, and I'm going to show this again, sort of over and over. I'll say this a lot, like when you see Elliott outside of the way that we teach it, you're going to see a lot of people sort of fixate on the Elliott wave impulse of 1, 2, 3, 4, 5 because they learn it, it feels good to them, and they just go with it. It's useful, but I see and I trade a lot more corrections than anything in the market because it's a really simple. It's just a simple adjustment to, like, if I think of 3, like if you're thinking of the impulse wave, it's 5 waves. That's what we said on the first chart, right? So it's a 5-wave pattern that's either going to go like 1, 2, 3, 4, and 5, or it's going to flip that and go the other way around. The first part of it is actually a 3-wave pattern. If you pay attention, it's 3. If you can learn how to trade that, you've got most of the market beat. Case in point, what I see here on screen. And I'll show Kim. I'll show them a lot because these are some actual trades that I usually get down in futures on the 3-minute, sometimes the 1-minute chart. So these are really down in the weeds. And I'm looking, like, if you want to know what size trade I'm looking for, I'm typically looking on a good day in futures. I'm looking for anywhere between 100. I guess say 100 to 125, maybe 100, 125, maybe 150 points a day is kind of my thing. And I'll tell you, just starting from this peak, which, like I told you, I like to see where the markets change directions. I could start from a much higher level because there's more Elliott wave stuff here. If y'all are paying attention, there's actually an impulse right through here, but I'm coming back to that. I'm just going to start in what seemed like an arbitrary spot. But I noticed the market starts moving lower. It's going to move lower to some point that's relative to something that's already happened, which is why I keep saying you have to have fib. So I'm just going to go back to here and sort of map this out. If I go from this point to here, right there, you can see that 44.7 hits right on the low before we bounce higher. From this downtrend, we're going to get another bounce. Watch this. 61.8. So if I were to follow some of the rules that we're talking about, and technically this is going to be, let me see if I can zoom in a bit. It's going to miss 61.8 just by a hair. And the reason I say this is because of the type of Elliott wave pattern it is. But if I go from here to here, I know that this move is coming, one. And I know how long it's going to be. It's going to be related to this move and also this one. And I'm going to take this from the measurement. I'm going to do something like this. Comes up to 61.8 and it's going to come down. How much is going to come down? I'm going to use these zigzag rules. So, and I'll label them as I go. Let's go. Yeah, let's use the real labels. Your first point in trading view is always going to be 0, and it's actually pretty convenient. Next point is going to be A, B, and then the guesswork is, of course, going to be where C is. I can see where it is, but if I was to back this out, again, in replay zone, if y'all use trading view, please make sure you use the replay. I love the replay. It helps you with your timing on just about everything. Of course, mine won't act crazy. Come on, let me try again. There we go. I didn't go back far enough. It's fine. So what I'm going to use is this trend-based fib extension tool, which basically is going to measure the length of the first wave, which is A. And I'm going to measure the length of it, click once, and then the next link is going to be it based off of wave B. If I go to my rules, over in the corner, I got to move y'all out of the way. It says wave C will be 61.8% of wave A at a bare minimum. So I knew once it started moving my direction at a bare minimum, I know it's going to be this if it's an ABC zigzag. But other levels is going to be 786, 886, and it actually comes down to 161.8 and a couple other levels. But these are the bare bone basics. So what I'm going to do is I'm going to put it on here at here and 161.8. We already have the 61.8, I think, on here. No negatives. Take the rest of these off. I'm just taking the rest of, because I don't know how people's sensitivity to line. I love lines on charts, so I can draw lines all day. But for everybody else, so at a bare minimum, right? I knew it had to come down to at least here, which to make a new low. But I knew it could come all the way down here. Why is that important? Well, if I'm entering at this 61.8% up here, I'm going to put another Fibonacci level on here, 70.07. What I can do is enter exactly, or as close as the candles allow me to, enter a short position up here at 61.8. Put my stop just above. Never put your stop loss on a Fibonacci level unless you wanted to get hit. Put it just above. This is only a few points. My first target, if you're looking at my very first 61.8% target, this is my baby target. I'm looking at 6.05 risk to reward. So for every dollar I'm risking, I'm getting 6 back at that point. But because of the Elliott wave rules and where I think this thing is going to go, my next target is way down here, where I'm talking about 15, almost 16 to 1. So a 1,600% gain on my risk. So if I'm risking $100, $100 of risk, $1,600 in a trade there. And granted, it went ahead, so you can kind of see there's some other levels that it goes down to. Like I can put 200% on here and it probably hits. But the point is not to be so exact every time, but the levels that it's actually going to hit. These are the ones, and you check them off in succession. First level comes through here, boom. Next level comes through off here, boom. So I'm going to replay it just so we can see how it plays out. Yeah, it goes on 261.8. Now stop, if I can stop this thing. Okay, so we got a first level. And remember, I was saying with Elliott wave, I thought it was going to go here. It goes lower, sure. Even if I got out here, I've gotten a tremendous bit. If it goes lower, perfectly fine. Leave some on the table. But the magic happens when you start to think, well, just like I have this wave, I can treat this whole ABC as one wave. One thing I didn't talk about much is that waves themselves are what we call fractal or self-repeating. Just like I can do that, each one of these waves has another little set of waves inside of it. That's how you're able to trade at a really large level and see these things, but you could also get down here to 3-minute, 1-minute time frames and see the same thing. It's self-repeating patterns. So I can take this entire move, and I'm going to take some of these lines off here. Take this entire move now and treat it as one thing or one wave, one solid wave by itself, from this very high point down to this low. And remember, I said before, all waves that are next to each other, they're kinfolk. If you can keep in the same sequence, and I'm making sure I'm staying at this high, making sure it's accurate, I'm taking the same Fibonacci levels, measure. Look at where that high came up. Came a little bit above it, but look, price action, again, kind of corresponds with it as well. But you can see this 70.07 hit. Well, what that tells me is that what's happening now is also related to what happened just before. So I start to use that and saying, well, okay, I'm starting to build a thesis that maybe the next wave in the set is going to go in the opposite direction. I've got this down, it's coming up, maybe down again, maybe it goes back up again, because that's still my very simple this. Okay, so let's try it. If I go from here, from this low up to here, it hadn't quite stopped here, but I'm going to assume it's probably, let's see, we're going to put a level on here. I'm going to put 88.6 on here, which is one of the lower bounds. Went a little bit through it, but I doubt it goes all the way. It may, I don't know, maybe this one makes a new low. See, put 114 on it, see where it goes. And let's go. Yep, not quite. Oh, it's not done. Same thing. Keep going. Notice how it's playing with these same levels that we pull from over here. I just add more Fibonacci levels from this point, and they're going to interact at the exact same levels that we had. And I'm going to change the color so you can see them better. Here. Yep, just about the same levels. Now, once you start recognizing the patterns that happen, like Kim was saying, you can keep the same motive going on and on and on. And you can see their interaction. I think that was that rate decision. Come right back through here, and it's going to go down. Speed it up. See the real. I didn't want to speed up that much. My bad, y'all. My bad. Let's go back because I want to show that again. I can show it from here. There we go. Now, can y'all see the move that happened in there? If I overlay this and make it bigger, it's pretty much the same thing. Same exact move. And just like measured out the one before it, if I take the measurement, I'm going to take some of these off so we can see them better. If I take the measurement of A from this low to this high, put 100 on here again, and it should come out a little bit high, a little bit high. It's my 88.6. There we go. 88.6. Again, this is, actually, I don't know what that is. Happened on the 7th at Asian market open. I don't know what that is, but again, market spiked to it. Once you get this move and it starts to move again and starts forming a base, I'm going to take another Fibonacci measurement and project out the highs. Just waiting. Just got to make another one. Yep. Come on. About here, I know it's about finished. So go from here to here. And I'm going to take these off. And we're running. I swear they slowed this down. They used to go faster. And you can see the market interacting with the fibs. This is how you know fibs work. Check out all that interaction. Then it finally breaks it. It's going to migrate to the next one. And as you can see, stop. Does that make sense to everybody? Are y'all still good? Because I'm actually going to now do an actual count based on that. But I want to make sure that we got how simple it is to use these ABCs to find spots to enter and exit the market. This is at a 3-minute level. This is what I do on a daily basis a lot. Everybody good? All right. So let me exit out of the replay and show what Kim was showing. What she wanted to see too was, actually, I'll put this other level on here just for reference. Yep. See that one? Hit right off of, I'll just a hair right there. But it hit at the top. That's based all off of just knowing this existed and then did a projection from here. All of this is related to this low, believe it or not. Like this low point, I'm going to do another just set. It looks sort of like this. And then the entire drop here is going to be related to everything that's happened. Let me take this out of the way. Take some of these off. But everything that's happened before, just like we were talking about in ABC form, I go A, B, C. Same thing. Hopefully you can see it here. A, this is all B, and this is going to be C. Technically, well, yeah, here. But you can know these again in advance. Once the B move is made, you can calculate C's length from A, taken from the end of B. And just to show, I think that was MK was asking about the different levels. I'm going to put another special level down here. I'm going to highlight it in yellow. you can see that this 144 again works a little bit better than the others, but it pretty much capitalized the low here. This is nothing but the same Elliott wave pattern over and over and over again. Now, I'd be remiss to not use what happened this morning, because this was a really, really good trade. You could have been on a lot of different time frames, but this morning was great. I get up really early because I trade continuous markets, and I get up around sometimes 3 or 4 o'clock. The same premise that we're talking about is what happened here. And all you need to get started is to see about this. Now, granted, you'd have to be up a little early. This was at open of Europe's market, but this low to this high, just like we were talking about, it's got to come down at a minimum 61.8, 50%. I can take the rest off because they don't really matter. Now watch. It hit 38.2, did not get down to 50, and wiggled up really quickly. Well, again, where was it going? I should have put this on here before, but if I was to take the length of this very first one from here down to the lowest point, and I put this here. These are impulse rules. Now I'm talking about, this is the one that everybody loves, is the impulse wave, because you go 1, 2, 3. Even if you weren't up to get the CPI news, once you saw this explosive 3, a lot of people, and I saw the volume in the futures market, a lot of people tried to trade in here, which was really silly. All you have to do is wait for 4 to form out and then play, I'm going to put it up here a little bit more, to 5. Well, these are based on, it's not going to be always the same here where it hits 38.2 here and then it hits 38.2 here, but you'll see. If I measure from 2, the distance from 2 to the top of 3, watch what the market does. I'm going to put on, take this one off, that doesn't matter. Take this, put this on, and we'll see. And these were just, I'm going to take these off too, because I don't want to crowd the chart too much. I'm going to slow it down a little bit because it took off admittedly a little bit faster than I wanted it to here. But I wanted y'all to see the actual effects. If it, there, I don't know what type of candlestick patterns you guys get into, or if you use candles at all. I use candles a lot. This is what I'm looking for. Again, this is what I call a partial bearish engulf. Some people call it harami. There's lots of different names, and then you got a pin bar hammer right next to it. But interacting with this 27.2% level, which again is different from this 38.2, because the relationship between wave 3 and this wave 4 are different. But when I get what I want, I know that it's going to turn 4 into 5, from 4, which is right here now, into wave 5. So this is an opportune zone to buy, because I can buy here. I know based on 4's length and 3's length what to expect for 5. Take 3 from the end of 4, and I'm going to put on here 38.2, 50, and at a top level, put 61.8. Sometimes it can go higher, but it's fairly rare. You can kind of see. But what I'm going to do now is form what we call a confluence. I did it once before. I'm going to take the length of wave 4, go from this high, go down to this low, and I'm going to put 127 on here. I may put 132 on there. I don't need many here. I can put 161.8 just in case. And this is my expectation for 5, to be honest, like right about here, because you can see where the different measurements that I've taken overlap. And when you first start doing it, it takes a lot. It really, really takes a lot, because it's like a time. Actually, it made a new low at the other one. So what you have to do here, I'm glad. Adjust this just a bit. You can see it in real time. Adjust this just a hair. And watch. Had to touch it. Touch it at the hair. And this was after me making an adjustment. You notice again in the beginning, and this is important with Elliott, this is important. I was wrong about the very first one. It touched there, made the candlestick. I took it. I would have taken a loss there, a small loss, but it came back to the next lower level, right? What's better than that? Took it here. And again, you're going to have losses still, but my adjustment, I still knew we were still in the same wave. Move the level down, just like I said, you make the adjustment. Instead of doing a partial bearish Harami, we end up getting a much bigger one at about the same level. You don't miss out on much. Take a loss. The trade here is still going to be, if I get here, put my stop loss just below this level again, and my target up here, I'm still almost 4-to-1. I'm still almost 400%. So I lose one. So instead of 400%, I'm 300% on the day. Big deal. That's how it works in real time. And as you can see, this is after day trading hours, but as you can see, it's floating up to some of the other levels. And if I were to kick out to a higher time frame, which I am now, slightly higher time frame, nothing really big, but this is generally how I work anyway. Let's go back a bit. I can go using the same method, same kind of look, find a high, look for a low. You can kind of see there's a pattern that kind of played out here, almost like an impulse pattern, but it's not quite. And I know that just from doing it a lot. But if I just take the Fibonacci levels from this high down to this low, I hope that's set. Let me make sure I got all those. And just bring up the usual suspects. And we'll probably put 76.81. It will likely interact with this 57.3. I should probably put 61.8 on here just as a notion, but I see the highs, price action, little price action through here. But what I'll look for is it interacting with this 57.3 because I had some other levels that were fitting right in there. And I can use the rest of the wave count to kind of, even if I start up from the bottom, why not? Let's do it. I'm going to go a little quickly on this. Let's do 75. Good. And I'm going to go from here to here, from here, and you'll see, let's do 161.8. Yep. Notice 161.8 comes right into where we are now. This in effect, a lot of people will try to count this. Usually when they learn about Elliott, they try to count this as an impulse. I can assure you that this entire thing is not an impulse pattern. But like I remind you, it's zigzag, just A, if I get it right, it's going to be your A wave. B ends over here because B makes that funky B, funky like W shape, and C is likely going to be up here. And if it doesn't go here, then you know here. It should start to turn or at least pause in this area. Now, if it doesn't, I'm wrong, so be it. But if you do this enough, you get a rhythm for the markets. And like Kim said, you can work off of the same chart for a very long period of time, no matter what time frame you work. Because again, you use Elliott wave at very large time frames. Because again, from the beginning of the year, there's another zigzag pattern doing just like this. Hopefully y'all can see that. The B wave part comes up right about here. But I'm starting from right here. Technically, the B would end right here. That's just a rule thing to give it that kind of whipsaw effect through the middle, but it's still the same effect. even if you measured from here to here, you would not be wrong in your measurements. And speaking of measurements, if I take a Fibonacci level from here, from this top point down here, you see the same 61.8% hit there as well. And if I measure the bottom here, you'll find out that it's some length of this very first move A. Put 132 on here. And 100. So, yep, there we go. So hopefully, Kim, that showed you what you wanted to see. Hopefully that showed everybody else a little practical. Hopefully it wasn't too convoluted. If it is, asking some more questions, I can get either more granular or I can go a little bit more high level.
Can you go back real quick to this, where the CPI number went up?
Oh yeah. Let's go back to here. CPI was here at 7:30. 7:30. I'm central.
Yeah, so that impulse wave that starts at the bottom, I just wanted to, share, like, for the most part, I trade options in the day and then futures at night. But since this is, NASDAQ or NQ, and then there's ES, I know there's a lot of like ES, or there's a lot of SPY and QQQ traders in the group.
Oh,
but,
okay.
But that pattern, I probably have seen at least 4, maybe 5 times, at least this summer.
Oh yeah,
Before the bell rings.
Yep.
So when you guys see that in like futures, think about how that can apply to your options, and you can I mapped this out throughout the day, and I knew kind of where to enter and exit just based off of what happened before the morning. So it wasn't me trying to get a quick candle here or 10% here.
Right.
I knew that the full play would get to that level by the end of the day, or at least within a certain time period. So just
because like she's saying, remember, if you see this move, it comes back to 38.2. Once it started to turn, and it went through it quickly on the sim. I apologize for that. But you measure here, you come back to here, your bare minimum target should be 100% of this move here. So I'll start highlighting your bare minimum target based on Elliott wave rules. And you're like, where are you getting these rules from? You have to kind of learn the system. Your next target's number 161.8. I'll take this 138.2 out. It's just like reading a playbook. It's like once you see what a situation is, and the maximum is going to be 261.8 in this situation, sometimes it's 300%. But once that move hits, you get this confirmation. And another, I don't use as much, but once I put the time on it, it starts getting nasty. Let's go here. And time, and granted, time is a very advanced subject. But this, if you have the patience to learn it, time literally teaches you how to time the market. What this is showing you, and I know there's a bunch of lines going everywhere, is that after you got this first little move up, which we're going to call wave 1. I'm sorry, wrong entry here. I'm going to put my Fibonacci retracement, comes out to 38.2% of it. Put this on, take these off. It hit almost exactly at 100%. So the length of time it took to make this move up, it took that length of time to go sideways and hit 38.2. That's a key indicator. That's one of your Elliott wave, like, hey, this is about to happen. Now, if I put 200% on here in time, you can see it apexed a little bit before that, but that's about right. You can see how the time and the price lines up. It makes these little crosses. That just lets you know that gives you more constraint to say, hey, this is the move that I'm looking for, or it's not. And the same thing, I can literally keep going. Just like, I was early on here. Maybe if I'd used my timing, I would have been better on the timing on that. For example, 233, you should do it. That was my first one. 300. That's a little bit behind. And 288 is going to nail it. 81. There we go. Yeah, so 288 was it. Wait for it. Hits the move. That's actually going to hit exactly on the number I first said, 886. Directly on it. And it's going to move out. So you can use these combinations. And again, like I know for a lot of people, this is like so advanced. It is for a while, but once you start seeing the markets, I can literally transpose from this market to futures to Forex to crypto to whatever. And I needed that when I started expanding, because what you'll learn is that sometimes your markets will get real dry. They'll start, volatility has not been an issue, and it probably won't in the future. But if you trade long enough, I've traded for almost 2 decades, you'll get to a point to where markets will dry up and your moves that you normally see will be much smaller. You don't want smaller moves because you take more risk. You end up taking more risk. Just go to another market. That's one of the things that saved my firm. We were like really hyper focused on one market. And we're like, oh, well, we can trade a bunch of other things. When we did that, we exploded. And we started able to offer more services and products to our clients. And we've got different types of clients. Even if you're not in the business, you can do this for yourself. You're your own client. You're your own business. So I added a little razzle dazzle here with the time, but the price, if you get just this concept, you can see where it goes. And like she said, it repeats over and over. There was a funny trade. Yeah, this was a good one. I remember this one. Funny trade in here on, I want to say this was like last Friday, that it dropped in, at like 61.8% of a level from here to here. And I remember that. And it was like another measurement. And once I knew it dropped in and made this specific candlestick pattern, it was off to the races. I'll show it. And you worry about being wrong some, but it's not really a big factor. For example, I'll tell you I like this move. Move straight up and it kind of chops down, takes up a good bit of time, lands at about 78% of the prior move. See here, go up, come back to 78, 81%. That's probably 81. Yeah, 81%. The next move up, now granted, it's going to take some time, but what you can expect from this move is going to be at least 138.2, but up to 200% of the same move. So this sets your bounds of expectations. Uh, 138.2, and you don't have to get all of the move, but I promise you, if you go from, we're down here at 12,873. If you're at 873 in futures, and you go all the way up, I can do the same thing on QQQ. I realize you said, you had a bunch of QQQ traders. I can do the same thing. I'd put my stop below the 886 level. Keep it pretty tight. Yeah, I did it almost automatically. So I got 23 points of almost 24 points of risk. And on my target, my upside target, maximum target is 382 points. That's 16-1. And the trade starts at 8 o'clock one night and it finishes at lunch the next day. That's pretty simple. And there are a couple other spots, like even here, this 76% time, like 76 is a really popular number in fibs, but it does not work like a lot of people. A lot of people will say, oh, well, I'm going to use it, whenever a market moves up and comes back. It's very situational. Sometimes it's going to work, sometimes it's not. If you're using fibs and you're having that problem with sometimes it works, sometimes it doesn't, think about integrating Elliott stuff into it, because Elliott will provide the sequence. You'll know I'm in a correction. Well, what kind of correction I'm in? I'm in the zigzag or a flat or am I a triangle? Am I complex correction? If you can figure out the play from that level, you'll know which levels are supposed to work because it's written in a rule book. It's a lot of rules. What you learn is what rules work and which rules to ignore. And once you get to that point, it really becomes a lot easier. And keep these levels in mind. Notice that as I come up here, push back, this 114% level, nobody's ever heard of 114.6, but it's a Fibonacci just like the rest. Look at it tag the low of that Friday trade that I'm talking about. And it tagged the low at the same time that if I pull another retracement from here, or I could have pulled it from the bottom, you'll find that the levels will start to overlap. That's really what you want, is overlapping levels, because that lets you know that there's a lot of market support and resistance here. As you can see, that 14, let me back this out because then you can see better. that 114.6% projection is at about the same spot at this as this 33%, which is not a common fib. They hit it at the same spot. If you're sitting around and you have long-term charts, and you should have long-term charts, even if you're trading down here, like say on the 3-minute, like I do, look at what happens. Just after the, market opens up. Oh yeah, I forgot about that. That was a good trade. That's a good trade through here too. Market opens up 8:30, does its thing, starts to get some direction after 9 when all the retail money comes in too. You get another one of these, it's really a kind of weird looking morning star, but look at where it sits. The lower end of the body turns, and that goes into the dynamics of candlesticks. The dynamic of a candlestick having a big red candle, a doji, which means that there's indecision in the market. At a Fibonacci level, well, you got 2 here. And sometimes you can confirm this with volume if you're watching a market like futures, but or Bitcoin. But if you're not, if you're like in Forex or if you're in stock, your volume doesn't necessarily confirm. And then you get a push off of that level. That's a signal within a signal within a signal. It's inception. This is where you get long. This is where you get long with control risk. If it does not work, you've only lost, hopefully if you're like me, you only lost 1% or less of your portfolio. If not, you're off to the races. And you say, well, how far do I go? I've shown you all night. You go from the prior move to the low, and you have to know the measurements. I take the measurement. I'm going to put on here a couple things. My first target is going to be 88%, but then I'm going to put the 114, 138.127, and maybe at my top end of 138. And I keep going through these because I know them so well. I've done them so much. It's ingrained. It takes a lot of study, but what else am I going to do if I'm trading for a living, right? And as you can see, it rocketed off this low, chopped all the way through the day, hit the 114, and you were out. That was it. And then it's doing the next thing where I got it in. So this shows that this level went into this level. That's how you target. Now there's some other stuff, depending on how much time we have, but there's some other stuff that you can do with these markets that confirm. Sometimes you'll see Elliott wave pattern in one market, for example, and you won't see it in another. That happens a lot for us in trading Forex. Forex is a very efficient market. You'll see, like today, it's funny, the relationship between the NASDAQ and the CPI report was positive for the NASDAQ, but for the US dollar, it was a negative. And that happens because if you think about it, if you go back 2 weeks, we had the Fed push up a 3/4 of a point of an interest rate bump. So in currency world, whenever you change the actual benchmark interest rate, you actually change the value of the currency, the borrow rate for the currency. So the US dollar gets more expensive, and it gets more expensive based on the forward-looking expectation of what they're going to do. But with CPI, with the consumer price inflation coming down from its peak at 9.1 or wherever it was, probably double digit last month, I forget the number, but it come down to 8.5. And you had a lot of that was energy related, to be honest. Once you had that come down, it lowers the expectation of the Fed coming back in September and saying, hey, we're going to hike again. So the dollar, in the eyes of a lot of currency traders, peaked out. So you saw a lot of selling of the dollar, like where you saw a lot of buying here in NASDAQ. And if you went to bond yields, you would see a lot of similar things too. You see going to be big bond reaction, but bonds, NASDAQ, tech stocks in general are related to, you'll see there was a bump in the S&P too, but equities, bonds, everybody knows that relationship, but also there's an implicit currency relationship there as well. But you can see.
Like there's a couple requests for.
Oh yeah, go ahead. Yeah.
Or you'd see a SPY chart and a Tesla chart.
All right, I should have known. SPY, you said SPY, not, let's go SPY. All right, what level, what do we want to look at? And as you guys can see, I do work on SPY all the time because it's literally the same animal. I've gotten a lot of the work done for you guys, but tell me what you want to see. Same thing I'm talking about in terms of that ABC. Here it is again. And this shows you that NASDAQ, SPY, they're all very correlated. A lot of your markets are going to have overlap, and your bigger stocks are going to have lots of overlaps with these. So you can actually use your indices and your wave counts on your indices to inform you on how your single stocks are going to work too. Which again, this is why I say Elliott Wave is a very powerful tool for those that take the time to learn how to use it. I can just start getting really granular in here. Let's go back a bit. I wouldn't necessarily call this an impulse wave, but it's going to work out almost exactly the same. But for real, I hope everybody gets what I'm showing here. Like this was not rehearsed, but this is just me showing. I probably was working with some students or something where it shows that from the high, this is back in beginning of the year, January, you chop down, and there's really an ABC pattern in here too. There's ABC patterns everywhere in the market. Yeah, I could show those. And I tell people all the time, if you want to learn Elliott Wave, trust me, ignore the impulse pattern at first. Ignore the impulse pattern, you'll go a lot further. If I just started going here, come back to here, and I'm just going to, and all you have to do to confirm is you measure. This is why it's so important. Taking you back to the beginning of the year, and I love this year because this year to me was the return of a market that behaves like a market. Everybody was just used to buying the dip going up. This was retribution for, again, traders that are kind of nimble. And here, go down. I mean, it plays out the exact same way to me, like every time. It plays out the same way. You get a market that comes up, you're getting your candlestick confirmations. Big bearish engulfing, a bunch of little ones kind of go sideways. You see the market getting eaten out here. Let's see, I got that right. And then we just start projecting based on this length, fib extension, come down, come back up. Your bare bones should be 61.8, but we all know it went a lot lower. But this is why people started freaking out. And I was like, I don't know what, I thought this was fun, because if you're able to trade, you should have just gotten short here. Should have gotten short here and just bouncing fade every move back into Fibonacci resistance as this move played out. And it's gonna show you the levels. It's gonna show you exactly where it's gonna go, and you just have to be patient. And if you don't want to place orders at those levels, all you have to do, I should have put some lower levels on here. Let's put the 200 on here while we're at it. This was 200. Let's put 200 on it. Yeah, sure. Oh, cute. 214. There we go. All right. Y'all see what I did, right? I mean, this is A, B, C. Now it's starting to go back the other way. Stop it like right through there. It's going to do literally the same type of move. You just kind of have to work with it.
Someone asked if you can project the next wave down on SPY.
Oh, like from current?
Whatever the next wave is on SPY.
Yeah. I mean, let's see. Let's get out of here. Yep. Let's go. So again, it's contingent on the levels having to turn, but it's the same sort of thing. And I always tell people, take it one step at a time. We already see the big ABC, right? Then what we should expect, it's not going to go all the way in one spot. So just watch it as it tips back up through these levels. Take some of these off and keep the ones that only really matter. If I go from this very high down to the low, we're already touching 50%. So assuming that this wave pattern here is done, We got this thing and we're done. I don't think we're exactly done, but we could be close. What we have to have is a little bit more economic pinch, but I think we could actually push a little bit higher. Not all the way to 61.8, but really 57 land is kind of what I'm thinking, because once again, you can see all the price action kind of going through there. But regardless of which one it is, simple Fibonacci extension from this high to this low. And the levels are important, but watch for the clues. If you watch any of the charts that I've seen before, you're going to get candlesticks to kind of turn at that time. And at the thing I like about indices, they don't just pop up like currencies, and Bitcoin can just pop up to the level and they're gone. But indices tend to roll over. Like even back here at the high, it kind of rolled over. So if you start to seeing candlesticks getting negative, more and more negative, and the chart going sideways at this level or up here, your next thing is to think, well, hey, at a bare minimum, I would expect somewhere either 50 or 61.8% of this, which is either going to be 360, 346, but it's commensurate to where it actually turns. So that number changes slightly. If it stops here and goes lower, then that's what I'm looking at. But like I told you, adjust your levels. If it goes up to 57.3 and turn, your level just rides up with it. 61 goes up to here. Now, if it starts to go up here, we're going to have to change the outlook a little bit, but that's contingent. It would also have to take a little bit more time as well. And that's because it's making a different type of wave. It's not a zigzag anymore. If it goes up above 61.8, and remember this, if you remember nothing for zigzags, a zigzag pattern will not really go much above 61.8. I allow a little, but by textbook, it's not supposed to go above 61.8. So if you're thinking like I'm thinking it's zigzag, and we start to creep up above here, the pattern's wrong. So just change your mind. And that's all I do all the time. It's like, I think I see what it is. If it's not, I just change my mind and keep going. But I'm waiting as it approaches these levels, start looking for the other clues. It's really simple. But yeah, 360, 340, somewhere in that range. Any other questions? Any other thoughts?
Someone asked for a Tesla chart.
Oh yeah, that's right. Tesla. All right, Tesla. So I've already been working on Tesla chart. It is again, this was not pre-planned. Here, now this is an interesting wave count. This is, and I know, I'm sorry, this is a little messy. If you, do y'all want me to start over, or y'all want to keep from here? Which one? Nobody, no preference. In the interest of time, I'll start from here. But what I basically am showing here is part of this wave count is going to be an impulse wave for Tesla. Let's see what level am I? I want to do it at 1 hour. Let's see what it looks like at 4. Now, Tesla was a really interesting one for me. I think I would actually change this count just a bit, because I do see, again, zigzag worked out, push back into here, but this part is not going to be a zigzag anymore, because remember what I said about the 61.8. The move moved higher, so it's in 81% territory. This type of correction is called a flat. Good thing is about flats is that you're going to see them a lot. The bad thing about flats is they have a lot of different looks to them. They change. They have a lot of different rules than the zigzag. You'd have to study them a little bit more. But this is one of my favorite patterns of flat, because it looks like the zigzag, but it kind of goes along, as they say, a flatter pattern. The pattern keeps along the same space. Like where it starts, it kind of goes, it'll make maybe a slightly lower low. Whereas in comparison, your zigzag is going to be more, it's got somewhere to go. It pulls back a little bit and then moves. Oops, let me try it again. I forgot to double click here. So both of these are corrections, and I can draw them the other way and they're still going to be corrections. It's not the fact that you're just moving down, but they make this three-way pattern. But this one is of the type that is the flat and not the zigzag. So what I have for Tesla is going to be a lot like what I have for NASDAQ. I think it can come up a little bit more, maybe double tops here, but you can see this is 61.8% of this entire move down. I think if it can't get over 914, maybe 950, we're going back lower. And you say, where lower? My 5 is down here. My count's already ready. I'm thinking maybe 640. Now, granted, things in the economy have to happen. You're going to start seeing more contraction. Maybe the GDP, the next GDP number comes up lukewarm. Maybe we had a little bit of growth, or maybe if we're negative, sure. Or if, you know, for whatever reason, the Fed decides that before December, they want to raise rates again, you'll start to see we kind of walk down this path. But the reason why I have it as this is not just the number sequence, but if I were to take the length of this entire move from here down to this low where we made in, you know, end of May, and we hypothetically say that, hey, it's going to stop up here. And I know there are lines, y'all are like, there are lines everywhere. But the yellow lines will show you that the 50%, 682 and 61.8% at 619 are very probable targets for it down to the downside if this turns out to be resistance, which is a lot of reasons to think that this is resistance right now. I think we're going to go back up and try to test it in the next few weeks. But if we start to turn over, and again, remember, Tesla is a big stock. It's one of your big tech titans, you know, S&P titans, whatever, however you want to look at it. If the major indices start to roll over, you're going to see single stocks like these start to roll over as well, and vice versa. Sometimes tech is a little bit more sensitive, sort of like small caps as well. Small cap index will sometimes be the canary in the mine and turn over a little bit more. But if you start to see this one turn over, expect the S&P or the NASDAQ to turn over as well, and vice versa. It's a lag lead thing. You don't ever see, you know, a company like Apple or Tesla or Netflix or one of the bigs in the tech high beta space to be up while the index is down, because the people that are holding one are also holding the other just by default. But yeah, I see it a little bit lower. Again, don't take this as gospel because I'm just preparing. I'm prepared to know where the market goes. I'm not predicting. And if you choose to use Elliott, please don't try to be like, oh, the market's going to go. You're going to be disappointed and not know what you're doing. And you're going to be like, man, this doesn't work any better than I already had. So don't be that guy or girl. Any others? Any other outlandish questions? Any doubts or confusion? There should be some confusion, but that's why we teach it. Y'all done on the chat? Going once, going twice. All right. So in closing, again, I hope I've shown a little bit about why Elliott is important. If you remember this, remember that as a trader, your job is to find patterns. Elliott tells you about patterns. You know, we talk about this a lot. I think the zigzag is a really easy step into Elliott patterns because it may seem like a lot of rules, but comparatively speaking to some other stuff, this is not a lot. But once you start to get it, you'll start to see it. It took me about a month or two to really start my eyes catching on. Now, there's one thing, if you notice about my charts, I don't know how you guys are about this, but I have to make this known. If you're looking for patterns in the market, and this comes from studying in optics and things of that nature, your human eye, and this goes back to Fibonacci's and stuff too, is designed to see, believe it or not, at a best ratio of about 4, if you say 4 units wide, whatever you want to call it, a screen that is almost square. It's 4 units wide by about 3 units tall. If you're in my trading view is like this by no accident. I can't look at the charts. I can't stand looking at charts like this. I can't do my Elliott wave like this. It's too wide. This is too obtrusive. The patterns don't stick out. And again, there's some science behind it, a lot of science behind it. It's just how your eye is made. The old school TVs, the 480p TVs and old 35 millimeter cameras that they used to film, early film, actually understood this very well. We went away from it with wide screens, but for traders, there are actually some trading monitors that have like 4 of these stacked together on like a 43-inch frame, but it's make sure that your chart is square. If you're going to do this, make sure you square up your chart. It's really easy in TradingView. You just pull out whatever this, with your alert panel, just pull out the panel and it pretty much gets it to where you need it. It helps you see the dips and the dives a little bit better than just when they're all flat. You can't really pick out waves when they're like this. So you have to take time to really form up your screens appropriately to get the best out of it. The other thing, again, is like, you have to use the rules, but the logic sequence of it all really kind of takes hold. And once you do it, I will warn you, you will not see the markets the same way, but it's in a good way. And it's helped me not only survive, but I've thrived being able to build on top of this. I have a couple other, I call it 4 pillars. There are 4 pillars of Elliott, but there's also 4 pillars of, I use technical analysis, as you can see, mostly chart-based, some quantitative things, but not really. Then I have fundamental analysis that has like a thesis that goes along with it. My trades have to kind of go along with the thesis. And then I have what I call intermarket analysis, which is basically showing the relationships between different markets. Like I was saying about stocks and bonds, most people know that relationship, but there's also relationships between different currencies, fiat currencies, and different commodities and different types of stocks, different sectors of stocks, basic materials, food stocks, those sort of things are going to play. And once you've seen the relationships between those, start doing the wave counts, you get a holistic look at what they call global macro. It's a hedge fund strategy where you can look at the top down from the market and see what's going on in currencies, bonds, equities, commodities, and you watch how money really just chases its tail around those assets. Crypto has entered into the fray, but it hasn't integrated yet. But I think over time, crypto will integrate as an asset class into this kind of global macro thing. But we use the same system. I don't have to, reinvent the wheel to trade whatever I want to at whatever time frame I was. And I was really happy about that because I wasn't a day trader. I was more of a swing or a position trader, but the being able to use my tools allowed me to get really nasty in futures markets. I trade a lot of financial futures, but also crude oil. Before natural gas did its thing this year, I trade a lot of natural gas, trade some heating oil, gasoline, things of that nature. So you just trade a lot of different things. You trade what you want based on what you see. And I think that's a really liberating thing. So Elliott Wave has allowed me to do that, but it's a core. And again, if you're using something else, you still can use that, but I think you can use this to figure out direction and timing to a very high degree. And I have to put in the plug. I would not be myself if I not put in the plug for Black's Academy, which we started. I really started this just so that I could give my experience an outlet to help traders that are really trying to maximize their potential. Because again, 15, 17 years ago, I didn't know anything about trading or any of the markets, but now I'm a market operator teaching other people. I have traders on Wall Street that have trained under me using these same techniques at my company, SC Capital, which is, again, an extra trading firm here in Huntsville, Alabama. But Blacks is the extension where I said, hey, I wanted to bring something to the community that wasn't just get rich overnight, because I didn't get rich overnight. I got rich, but I didn't get rich overnight. But and it wasn't through, again, trading, teaching. I had just started teaching. I made my money in the markets. It just changed my life. So I know these things work at a high level. I hope I get to tell you that they work when I get $100 million in assets under management. And I hope I can keep going, so if they don't, I'll let you know, but come check us out at Blacks, and we have this course and a lot of other stuff too. So yeah, and I appreciate you guys' time. I look for any other collaborations that may be available. So thank you for your time and attention.
Hey, appreciate it, bro. Appreciate it. And I'm gonna drop I'm gonna drop a link in here as well. I already said in the chat that got us a deal on them trainings, because I'm about to go ahead and get on that too, bro. It's just the way you broke it down was in a way I never heard it taught before, because I've heard of Elliott waves, and I guess having somebody, of course, to be able to like really explain them. But then just the fact that I went on the website and there's like all these different, ways to structure and different. It is, bro. Yeah, I'm about to put the link in the chat. So you let me know what you want to do. I already have to record, and I'm gonna stop this recording.